Welcome to Discovery Watch with John Kaiser.
I'm your host, Jim Goddard. Welcome back to the show, John.
Jim, pleasure to be back on the show.
John, Sonoro Gold Corp lost a third of its value last week after it published a PEA for its Cerro Caliche project in Mexico. What did the market not like about the economic study?
Well, there were a couple things the market did not like, but above all, it was that the gold grade came in below 0.5 gram per ton. In fact, it was 0.41 gram per ton. The market and myself had been expecting the grade to come in a range of 0.5 to 0.6 gram per ton. I had, in fact, created an outcome visualization where I imagined a future resource of 75 million tons of 0.55 gram per ton, and that generated an after-tax NPV that was, over somewhere between $1 and $2 a share, depending on what the gold price happened to be. But the company was never planning to deliver a resource at the 75 million ton level. They had only done sufficient drilling of a tonnage footprint that we were expecting 25 to 30 million tons, and they came in with 32 million tons for 15,000 ton per day operation that they're running for 330 days. But there have been no deposits at 0.4 gram per ton put into production. So some shareholders, when they saw the grade, 0.4, they bailed saying, that's not for me. However, when the stock dropped to 20 cents, that attracted an entirely different audience because they saw that even with this 0.4 grade and a 1750 base case price, even though gold has been more in the sort of $1,775 to $1,800 range of late, the PEA delivered an after-tax net present value of US $41.5 million, which is above the $32.2 million capex, which is what developers want to see, and the internal rate of return was 32.4%, which is also well above the minimum 15% everybody wants to see. So if you believe the cost numbers are correct, the project still works. However, the company has 102 million shares, and that NPV of 41.5 million US converts into about $53 million Canadian at the current exchange rate. So you end up with a after-tax NPV value per share of about 52 cents. And the stock was around 30 cents, and the market said, oh, that's not a huge amount of upside. So some players also bailed because of that reason. So we're now seeing a rotation of the audience from those who are more interested in momentum gambling gains to return on investment types that understand that 1750 gold is probably not the long-term price. They believe in a more significantly higher price. And they also understand that the company had to end up reducing the average grade. They're still going to mine 0.5 plus gram gold in the first few years, but they wanted to show that there are at least 6 years of production at a commercial scale level. They've done enough exploration drilling on the property to show that there is significant potential to boost the resource into the million ounce plus level. It's not going to happen overnight, in particular to the south of the main pit areas of Buena Suerte and Japoneses. They put some roads into the hills where nobody has ever drilled before, and the road cuts revealed that the structural zones that host the mineralization are present. They will, when they can, resume drilling in that area and start building up the ounces. And of course, if they get this into production and start mining the higher grade ore in the first years, it's not going to be too difficult to push higher grade ore onto the heap leach piles and make the cash flow a lot better than is outlined by the ore schedule that they're pretty much stuck with based on the resource estimate that they have put together. So the stock at 22 cent level was bad news for management and for existing shareholders, but everybody on the sidelines who was unsure about what the cost structure of this operation would be, they were doing a happy dance, and so they're in there buying now. Now, the other issue is that when you take that $53 million value and 102 million issued shares, you get a future price of 52 cents. But there's 166 million fully diluted, and of that, 56 million are warrants at 30 cents, which are good until April to August of 2023. So that's going to be a lid going forward. And if all of those get exercised, yes, they get part of the capex funded by the dilution, but that turns your NPV per share back to down to 32 cents a share. So the stock kind of already was where the valuation came in at, and so the market retreated. And so for the newcomers, they have a 50% upside before we hit that 30-cent level, where the market has to start digesting the warrants as people exercise them. As the stock price creeps above 30 cents, there will be those who don't want to hang around. They'll sell against the warrants and then exercise them, and the company will get a trickle of money into it. Now, for me, this is actually a good opportunity because I went back to my outcome visualization and replaced the grade with the 0.41 gold and the 4.1 gram silver. The gold has a 74% recovery, which they reported about 3 or 4 weeks ago. The silver only has a 27% recovery, so it is really an inconsequential part of this mining plan, which is going to be open pit heap leaching. But I ran the thing with their numbers, their cost numbers, and 0.41 as a grade, 75 million tons. And if you do the NPV on that for a 14-year mine life at the current spot price of $17.74 gold and a 7% discount rate, I come up with an NPV of 143 million Canadian, which is about 83 cents a share on a fully diluted basis. Now, again, that's not huge upside, but suppose you plug in 2,300 gold. The model jumps to $1.90. And if you go all the way to $3,000 gold, it goes to $3.28. So Sonoro Gold's Cerro Caliche project, now that we've discovered the cost structure, to a sophisticated audience, it shows that there is a lot of leverage on the upside if gold does indeed go into that $2,000 to $3,000 range. Now, of course, the big question now is, what is the future for gold? A lot of people think that the future belongs to Bitcoin and that gold's future is actually a lower price. And we're seeing this in the market because there's a reluctance to take even the current gold price level seriously. But there'll be people who say it's just a matter of time before we see gold readjust into that $2,000 to $3,000 range, and it's not going to be because there's roaring inflation dragging up all those capex and opex numbers in this PEA. So the stock is attracting that type of investors. However, some of the people who bailed will have also said, that $32 million capex that you have, which is 41 million Canadian, if you're going to raise that as equity, you're going to dilute away all the upside, especially if your stock stays stuck here at 20 cents. And the market can get trapped in this kind of chicken and the egg problem. But this is where the chairman, John Darch, comes into play. Most of the work in the past 2 years, he has been riding shotgun, cracking his whip, making everybody do it. But it's been all the people like Jorge Diaz, Ken McLeod, Mel Herdrick, who've been doing, and also the people at Micron who are responsible for the 43-1 aspect of the PD. They have been doing all the work. But now it's showtime for John Darch because his background is in fundraising. And there's a couple of options other than equity dilution to raise that capex. One is to secure some sort of gold loan, but another one that he has seen a lot of interest from is what they call EPCM. And EPCM stands for Engineering, Procurement, and Construction Management. And that phrase is usually used when the group that's going to build the mine also ends up bringing the money to build the mine, usually either loaned from them directly or indirectly through some affiliated third parties. And of course, the price for this is that they're going to pad the costs with a management fee, so your NPV will go down, but you avoid the equity dilution that you get from raising the money in the open market. Now, the project is in Sonoro, Mexico, and they believe they can get this permitted in 6 to 9 months. And with the publication of this PEA, they start that process or continue the process that was already started, but they now are aiming for the finish line. And you scratch your head and say, how can you get something permitted in 6 to 9 months? With the stibnite mine in Idaho, this has taken over 5 years, and it's still not clear that there is any mine approval in sight for an open pit mining operation. Well, this is in a location where there are no ejido villages nearby. There are no drug cartel problems. There are no sensitive habitats that environmentalists can get worked up about. And the area is surrounded by other operating mines, and the permitting agencies are familiar with the whole process of, how do you properly operate a mine, what needs to be done so that we can approve it and everything works out. So they're fairly optimistic they can get this done in the next 6 to 9 months. So this is an unusual story for a resource junior sector. It's a relatively small NPV story that they are trying to build. The mine life's only 6 years, but they've got everything in place to demonstrate that they may have 12 to 18 years of mine life and they're doing it at a 15,000 ton per day commercial rate, where you probably don't want to make that any bigger. But if they get this going, they become a potential takeout target for another existing operator, such as Argonaut Gold. Or if they pull this off successfully, they could also use this as a stepping stone to say, hey, we have the technical team. We know how to get things done in Mexico. We now have the cash flow coming from the gold mine. We will acquire other projects and also repeat the Cerro Caliche story and build this company into a multi-mine operation. So when they published the PEA, that was a very important milestone that they've worked for the past 2 years on. They did not clear it with delivered with as glorious numbers as the market was hoping, but the numbers are still good. They will serve as a foundation to attract new shareholders and hopefully the financial backers, either through some sort of gold type loan or through an EPCM contract. And it's a completely different story for the typical resource junior audience. It's now more for people who want an indirect bet on gold, a leveraged bet, and are looking for a gain that will unfold over the next 12 to 24 months as they get this project permitted, funded, and built.
We'll have more with John Kaiser right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with John Kaiser. John, Nevada Exploration Inc. finally published the results from its deep core hole in Southgrass Valley, but the stock did not lose half its value like New Legacy did when it published Rift Anticline results. What did we learn?
Well, Nevada Exploration Inc. kind of lost its value before the results came out as the market became increasingly impatient with why this hole that was started in March, why don't we have assays yet? It was in that 18 to 20 cent level. It had climbed to that after they did a 13 cent financing a couple of months ago, a financing that comes free trading in October, but it had already drifted down to sort of 14, 15 cents. And then when the result came out, the stock just sort of faded to the 11, 12 cents, nothing dramatic, such as an overnight 50% drop that the New Legacy suffered when it put out the results for its first 3 holes. Now, the reason that New Legacy went down so abruptly is they had a clear concept of where they expected to find gold mineralization. They were looking for a big, fat gold rush cigar, 10 million ounce deposit, an elongated, 4 kilometer long, 400 meter wide zone that sits within the along the axis of an anticline, and that's why they've named that the Rift Anticline, and it's about 15 kilometers to the north. And they knew that Wenban 5, which is the preferred gold sponge in the Cortez district, was present in considerable thicknesses within this whole geology, and they had found that out, confirmed that late last year when they drilled the first 4 holes. But what they reported was that, it's all altered. It has Wenban 5 in it, and we have numerous short intervals with gold spiking up to 130 ppm, but they did not provide any graphics showing us what the distribution was, which was a change from what they were doing earlier when, like Nevada Exploration Inc., they were showing an abundance of information to help people understand what is evolving. So the market has sort of taken a step back and said, you guys are where NGE was 3 years ago in 2018-19 when they were drilling their first grid of 10 core holes, trying to figure out the geometry of the underlying geology. And you don't yet know where the structure is that will have soaked up mineralization. And you can, just having Wenban 5 isn't good enough. It has to be in the right location where the fluid is being pumped through with great intensity. Now, the situation at South Grass Valley is different. They did 2018-19, they spent drilling their 10 core holes, which was supposed to be a vectoring strategy. They only got gold spikes here and there, very narrow, usually associated with very narrow fractures here and there. It didn't really mean anything. The main importance of the drilling that they did was to show that the lower plate layer cake was here. When they studied all the different formations, they identified the Cambrian limey mudstone as the one with the best characteristics for being like the Comus Formation at Twin Creeks, or the Wenban 5 at Cortez, or the Popovich in the Carlin district. But their issue at South Grass Valley is that they're not, if you go take a 40-kilometer radius around that South Grass Valley target, there is nothing that hosts any meaningful gold mineralization. And the stratigraphy, although lower plate, is different in this area farther to the south. And the CLM, as they call the Cambridge Limey Mudstone for short, there are no deposits where the CLM has clearly served as a sponge. So it is a bit of an unknown whether or not the CLM has what it takes to soak up Carlin-type gold at ore grade levels. But what they're drilling in 2018-19 did, and the follow-up RC drilling last year, was to outline the geometry of the stratigraphy, confirm that the fluid flow was from the east towards the west, and it was a Carlin-type system. They have all the pathfinders confirming that, and that this flow was over, this hydrothermal cell operated over a very substantial area, so it was a powerful system, and it did alter everything. But the question the market has been wondering is, well, yes, okay, but was it fertile with gold? I mean, maybe you just had the Carlin pathfinders, the arsenic, the antimony, the thallium, the mercury in there, and there wasn't very much gold there at all. Or maybe none of this stratigraphy is good for soaking up gold, and while some of the pathfinders have been soaked up, the gold may have just been dispersed throughout this giant area and not piled up anywhere. Or an even worse scenario is that, well, maybe the gold payload was lost deeper because there was a really good sponge coming up that pulled all the gold out and left the rest of the stuff to go to the surface and disperse whatever minor amount of gold was left in it. And the market, has been worried. The company spent $6 million on this project, has yet to come find anything that approaches an ore grade interval. And so there was a lot of interest in this hole number 12 that they started in March, and they spotted it at the northern end of the grid. They actually stepped out beyond the core hole grid into an area where they knew that the bedrock got deeper. And they did this because from their understanding of the way the stratigraphy behaved, this was an area where you would be more likely to find a laterally extensive gold zone than at the southern end. The southern end is where they now have number 13 stranded in the gravel, is, in my view, much more interesting because there the stratigraphy drapes over the Grass Valley intrusion. And the Grass Valley intrusion is similar to the Mill Canyon stock in the Cortez district and the Gold Strike stock in the Carlin district. And these intrusions took place 150 million years ago or so in the Jurassic period, well before the Carlin window of 45 to 42 to 25 million years ago when the Farallon subduction slab rolled back and unleashed these brines that had ponded underneath the crust and basically formed these incredible deposits in northern Nevada, starting up in the Long Canyon area in the northeast and all the way down close to the Walker Lane where Waikato and Northumberland are located. So what the stock does is when it intrudes this layer cake of lower plate carbonates, the horizons that are particularly carbonaceous, they tend to be more brittle than the others. So they end up being crackled from the pressure of the stock. And so where this stratigraphy plunges to the east, down into what they call the Water Canyon corridor, that is where it should be broken up and provide much better porosity. Now, what NGE has that New Legacy does not yet have is that Water Canyon corridor. And they had no idea it existed until they blown through $6 million drilling all these core holes, logging all this stuff, figuring out the angles, the stratigraphy, doing their seismic surveys, geophysical surveys, piecing it all together. And hole 12 was important because they developed this East Golden Gorge target to be centered right over this Water Canyon corridor, which is a structural feature into which the stratigraphy dips from the west. And it is where the stratigraphy dips into it, if indeed it was the fluid conduit bringing up these ponded brines loaded with gold. When it hits the Cambrian limey mudstone in this area, this is where the gold should drop out. And that hole took several months to complete. And when they finished it, it was down to over 1,400 meters. And they had this 150 or so meter interval of the CLM. And that was a huge success because what they were encountering before that was very confusing until they passed through that structural feature into the stratigraphy dipping from the west. And it was very altered. It had their XRF unit gave very high arsenic readings, the highest yet. And it looked like the sort of stuff, wow, this should run gold. And yet when the assays came in, it showed that it had only spiked up to about 100 ppb. So that was a big disappointment for the market. This is not a discovery hole. However, it did have some very subtle information that's important because what they observed when they got the geochemical assays, which include the gold assays, which you can't get from an XRF unit reading, they confirmed that yes, the arsenic levels are what we expected them to be from the XRF unit, but more importantly, the gold grade is tracking the spikes of the arsenic level, meaning the gold is part of that fluid flow, and it's pretty much continuous with variations, which is different from what they encountered in the CLM farther up dip, where the CLM pretty much did not have anything more than very, very low anomalous gold and pathfinders. But this was showing that where the CLM dips into this Water Canyon corridor and the fluid flow was most intense, it was operating as a sponge, and picking up some of the gold. Obviously, in this particular location, the conditions weren't exactly right for ore grade to develop, but it does give a lot of support for the hypothesis that when they get their 10 core holes done along the rest of that 3,500 meter strike, they will eventually tag into ore grade mineralization. And once they have that, then it's a different ballgame. Then the Barricks of the world come knocking on the door and say, gee, can we do a farm-in or something like that? Because of the depth of these holes, though, where the target is likely to be, this will be very expensive drilling. And that's why the market would prefer to see the hole 13 get done and Wade finally get lucky and have an ore grade intersection in this area where they also expect it to perhaps not be as deep as farther to the north. So the market now has the sense, okay, we know roughly where you need to drill to find the gold at rift anticline. We don't know yet where you need to focus your drill. You're going to have to wait for those other 4 or 5 holes that you've got going and maybe drill some more so that you can piece together the geometry and vector in on where you should be drilling. So New Legacy may have another year left unless they get lucky before they are in the sort of position that Nevada Exploration Inc. is right now with its Southgrass Valley project. And the problem, of course, is where do you get, how do you find a replacement driller? They started drilling hole 13 on May 27th. On July 7th, they told us, the drillers who were really good, they were able to complete that first hole. We loved them. They just packed up and quit and went for another job that was perhaps easier than this one. And they have been unable to find a replacement crew. That's actually the drilling company's job. But in Nevada, there is a widespread shortage of competent drillers. And there's the added complication that for health and occupational health and safety reasons, drill crews have to pass the drug tests. Their pee can't have any THC. And as far as I know, although in Canada you can smoke all you want, it's not a problem. It's still a problem in the United States, and apparently cannabis is a very popular recreational drug in that state. So they have that added problem that if your pee doesn't pass the test, you can't be a driller. So how and when this shortage will be solved, we don't know. Right now, all we can do is wait and hope that they find a competent driller, get this hole going, and then cross our fingers that it gets completed to target depth and that the CLM in this particular area has the perfect conditions with the fluid flow coming up this Water Canyon corridor loaded with gold and all the pathfinders, and finally give us a discovery hole that validates the Southgrass Valley play and the entire concept of using groundwater sampling in the valleys of Nevada to find these blind hotspots that are altered lower plate windows in an area where John Montine's theory says, yes, the slab rolled back. If there were deep structural features that channeled the fluids upwards into your layer cake sponges, you're going to find Carlin-type mineralization.
John, thank you so much for the update.
You're welcome, Jim.
We've been talking with John Kaiser, his website, kaiserresearch.com. I'm Jim Goddard.
Comments made on Discovery Watch are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at howstreet.com. Discovery Watch is a production of How Street Media Incorporated.